Hello, and welcome to Lightbulb Finances. What if I told you you could earn money, real money, every single quarter for the rest of your life without ever working another hour for it? That's not a sales pitch. That's not a scam. That's called a dividend stock. And in the next 10 minutes, I'm going to show you exactly what dividend stocks are, how they pay you, how much you can realistically make, and the simplest possible way to start, even if you only have $1. By the end of this video, you'll understand the most powerful, lowest effort, lowest risk passive income asset that exists. Let's get into it. So what exactly is a dividend stock? When you own a share of a company, you own a tiny piece of that company. That part you probably knew. But here's what most people don't know. Some companies are so profitable, they pay a chunk of those profits directly to their shareholders, every 3 months, like clockwork, forever. That payment is called a dividend. If you own 1 share of Coca-Cola, you get a dividend every quarter. If you own 1 share of Johnson & Johnson, same thing. Procter & Gamble, Verizon, Realty Income. There are hundreds of companies that do this. You don't have to sell. You don't have to time the market. You don't have to do anything. You just have to own the share, and the company pays you for being a part owner. This is the closest thing to legal magic that exists in finance. Now let's talk about how much you can actually make. Most quality dividend stocks pay between 2% and 6% per year. That doesn't sound like much, but watch what happens when you let it compound. Let's say you invest $100 a month, every month, into dividend stocks paying a 4% average yield. After year 1, you've put in $1,200. You're getting about $48 a year in dividends. Small, boring. After year 5, you've put in $6,000, but you're also reinvesting every dividend, so you're earning around $400 a year in dividends. After year 10, you've put in $12,000, but your total account is closer to $15,000, and you're earning around $600 a year in dividends. Now here's where it gets unfair. Keep going. After year 20, you've put in $24,000. Your account is $60,000. You're earning $2,400 a year in passive income. After year 30, your account is over $130,000. You're earning $5,200 a year while doing nothing. After year 40, you've put in $48,000 total, but your account is now worth over $300,000, and you're getting $12,000 a year in dividends forever. $12,000 a year from $100 a month, just because you started early and let it ride. This is why people who understand dividends never panic about the stock market. So how do you actually start? Let me give you the dead simple process. Step 1. Open a brokerage account. The 4 big ones are Fidelity, Charles Schwab, Vanguard, and Robinhood. All 3, all take 5 minutes. None require a minimum deposit. Step 2. Pick your strategy. You have 2 real choices. Option A, buy individual dividend stocks like Coca-Cola, Johnson & Johnson, Procter & Gamble. These are called dividend aristocrats, companies that have raised their dividend every year for at least 25 years. Option B, buy a dividend ETF. An ETF is like a basket of dividend stocks bundled together. The most popular ones are SCHD, VYM, and NOBL. With one purchase, you own a piece of dozens of solid dividend payers. For beginners, option B, buy SCHD or VYM and call it a day. The basket does it for you. Step 3. Turn on dividend reinvestment. Inside your brokerage settings, there's a toggle called DRIP, Dividend Reinvestment Plan. Turn it on for every dividend stock you own. This means every dividend you receive automatically buys you more shares, which generate more dividends, which buy more shares, forever. This is the compounding engine. Without DRIP, you're leaving money on the table. Step 4. Automate your contributions. Set up an automatic transfer from your checking account into your brokerage account, even $50 a month, even 20. The amount matters less than the consistency. Most brokerages let you set this up in 2 minutes. After that, you forget it exists. Your future self gets rich while you live your life. Step 5. Do nothing. This is the hardest step. The market will go up, the market will go down. People on the internet will scream that the world is ending. None of it matters. Your dividend stocks are paying you regardless of the share price. When stock prices drop, your dividend reinvestments actually buy more shares, which means more dividends forever. A market crash for a dividend investor is a discount, not a tragedy. Now let me cover the biggest mistakes beginners make. Mistake 1. Chasing high yield. Some stocks pay 10%, 15%, 20% yields. Run. These are almost always traps. Companies that pay unsustainable dividends, cut them, and the share price crashes. Stick with 2 to 6% yields. Boring, reliable, safe. Mistake 2. Picking too many stocks. You don't need to own 50 stocks. You need to own 3 to 10 quality ones, or just one good dividend ETF. Less is more. Mistake 3. Selling when the market drops. Your dividends keep paying you. The share price will recover. Selling locks in the loss. The people who become millionaires from dividends don't sell, ever. Mistake 4. Not starting because the amounts seem small. Every millionaire dividend investor I've ever read about started with small amounts, tiny amounts, embarrassingly small amounts. The first dollar matters, the first month matters, the first year matters. Here's the truth nobody tells you. Time in the market beats trying to time the market, every single time. A person who starts at $25 with $50 a month will beat a person who starts at $35 with $500 a month. Almost every time, because the compounding has more time to work. Time is your most valuable asset in this game, not money. Now, let me address one big question. What about taxes? Dividends are taxed, but qualified dividends, which is what most quality dividend stocks pay, are taxed at the long-term capital gains rate, which is 15% for most people, or even 0% if you're in the lowest tax bracket. That's much lower than your paycheck, which is taxed at 22, 24, or even 32%. To make it even better, hold your dividend stocks inside a Roth IRA. Inside a Roth, your dividends grow completely tax-free, forever. When you withdraw at retirement, you pay zero tax on the gains. A dividend portfolio inside a Roth IRA is one of the most tax-efficient income streams in America. Here's what I want you to do today. Open a brokerage account. Robinhood is the fastest. Fidelity is the most respected. Either one works. Deposit $5. Buy 1 share of SCHD. Turn on dividend reinvestment. That's it. You're now a dividend investor. You're now in the same game as Warren Buffett. Same brokerage, same stocks available. Just smaller numbers. The hardest step is starting. Once you've made one purchase, the rest gets easier every month. If you commit to $100 a month for 30 years, your future self will be earning thousands of dollars per year, passively, from companies you owned a piece of. That's not motivation, that's just math. If this video opened your eyes, hit subscribe. I'm breaking down the next asset in the series next week. We're covering digital products, the asset that lets you build something once and sell it forever. And drop a comment below. What's the first dividend stock or ETF you're going to look into? Coca-Cola? Johnson & Johnson? An ETF like SCHD? Whichever it is, write it in the comments. Then go open that brokerage account today. And remember, the rich aren't smarter than you. They just understood decades ago that owning a piece of a business is the easiest way to get paid forever. Want the full playbook? Check out the rest of the Light Bulb Finances series, linked in the description. Each video breaks down one asset in detail. Watch them all, and you'll have everything you need to start earning while you sleep. Thank you for watching, and please subscribe, like, comment, and share this video. It helps out greatly.